If you're a savvy saver, here are 3 high-yield, low-risk options to consider in the short term. Especially with major banks in Singapore cutting rates on their high-interest savings accounts as the US Federal Reserve signals rate cuts. So what are the options for you to optimize your cash?
Given that there is a higher interest in environment now, so if you can get a higher return over maybe 1 or 2 years period, maybe you can lock up that first and invest in something which is a short term. I will give short term as less than 3 years, and then try to book as high an interest as you can get, which is coming as sort of income into the fund by the coupon payments that you get over time. So that's one example of it. So T-bills is you buy at a discount and then you get the face value at the end.
Treasury bills, or T-bills, are debt securities issued and backed by the Singapore government. T-bills have maturities of 1 year or less. Singapore savings bonds and government securities, also backed by the government and considered low risk, have longer investment durations.
I would say users should look between fixed deposits at banks, between the T-bills, as we correctly said, and other cash management solutions, and see at what point in time, who's offering a relatively better, rate. What we do expect is that essentially these kind of move in tandem.
Cash management solutions come in different shapes and forms.
The most common one is through money market funds. These are working with fund managers who invest in, again, a portfolio of T-bills, securities, relatively very, very low risk and very, very, high quality, like the AAA grade, the highest quality. Most of it is typically some version of government or government-backed securities, MAS T-bills, and so on and so forth. The other kind of cash management, which has actually become quite popular in the last 6 months, is actually fixed deposits, which are offered through some providers. And a level up from them typically becomes, income solutions, which are typically a portfolio of corporate bonds.
In the medium term, Aurobindo suggests taking on more risk.
So I would say for a longer duration, you are better off holding to something like an ETF, or even through robo-advising companies. The other option is to invest in the stock market indirectly, passively through ETFs and other instruments that are out there. And last but not the least, you can directly invest in stocks which are blue chip stocks.
I would say sectors which have traditionally dependent on capital, such as infra, such as REITs, such as anything which has kind of suffered from the higher interest rate environments, I think those start becoming very, very attractive. In the last, I would say 6 to 9 months, for example, the iEdge REIT index on average gives a dividend yield of about 6%, which is very healthy if you think holistically.
Besides REITs, value plays are also set to do well in a low interest rate environment and if global growth slows down.
Suppose there is a higher likelihood of slower growth, which is where the interest rates are often cut, slower growth, maybe a recession, maybe a short time that might be coming in. The ones that tend to do better are consumer staples, which are sort of almost non-discretionary expenses. The ones that tend to do worse oftentimes is technology, because they need a significant amount of cash infusion as well. A lot of investors will go towards value stock rather than growth stocks, where things can be very volatile and come down as well.
In the longer term, look at longer duration securities.
Where would Singapore savings bond or government securities or treasury bills come in? I think it comes in essentially at the front end, which is the shorter term to sort of medium term. You can invest in a long term one as well, and then you have a longer term bond, which is giving a higher coupon payment over time. That is one option, that they can kind of lock in that higher coupon payment earlier and hold on to maturity if indeed the interest rate comes down. So I'm talking about both government, longer term government bonds or corporate bonds.
As with any investment, it's always important to beware of the risks involved.
Every asset class has its own kind of risks, right? Now, traditionally, if you would take cash management solutions, they are very low risk. So the only real risk you run is that if there's a massive, spike up in interest rates, then the value of your, underlyings kind of goes down. In fixed income solutions, typically you talk about duration risk, you talk about, counterparty risk, but typically one of the highest risk is default risk.
This is kind of a cliche that there is really no free lunch. So anytime there is the investment that is being offered, which is paying you a higher interest, you have to read the fine prints, exactly what you are given up. So typically, the one that you will probably be giving up is the provision of the deposit insurance scheme. The local banks here will be guaranteed by the Singapore Deposit Insurance Corporation. So SDIC will guarantee a maximum of $100,000 on the deposits that you're holding in some of the accounts. Not all bank accounts will be covered by this SDIC.
As investors watch for signals from the US Fed, they'll need to stay nimble to adjust their portfolios to changing market conditions.
Singapore doesn't have any capital control, so whatever the international interest rate is, so typically close to the federal funds rate, which the US interest rates are, will be closely tracking the Singapore interest rates as well. So investors here should be cognizant that interest rates might come down, but not probably right away. So maybe in near future. Over the next 1 year, there are expectations of inflation, interest rates will be cut several times.